Welcome, I'm Cody Koch. This is a question and answer video. Let's get to it. SBA loans are commonly used for business acquisitions today, but SBA loans have not always been available. How do you buy businesses if SBA loans are no longer available? That's a good question. All right, for starters, SBA stands for Small Business Administration. This is referring to guaranteed loans. What they do is the SBA guarantees to a bank, a lending institution, if somebody defaults in an SBA loan, the federal government will cover that loan. Think of it as the government's a co-signer for an SBA loan, in a manner of speaking, okay? So that's really what's going on. SBA loans, yes, they've not always been around, especially for business acquisitions, and SBA loans have a tendency to change the rules and the requirements. Sometimes they get very easy to get, and sometimes they become very difficult to get. But I will say this, business acquisitions occur all over the world in mass. There's lots of business acquisitions every year all over the world, and the SBA program that we have in the United States, or anything equivalent, does not exist in the vast majority of those countries. In fact, I don't know if any other country has anything like the SBA loans for business acquisitions. So it's very unusual to have SBA loans. I actually am perfectly fine in an environment if SBA loans were no longer used for business acquisitions. And the reason I'm okay with that is because the SBA loan system actually distorts market prices in such a way that it actually makes it much easier to sell businesses for sellers than it does for buyers to buy those businesses, as strange as that is. And it often encourages people to overpay for those businesses. So a no SBA loan environment would actually be favorable to us because it doesn't distort the market so badly. All right, so that's not the question though. So the question being is, how do we buy businesses without SBA loans? Typically how an acquisition works is the buyer or buyer team goes in, they put a down payment. Let's say it's a $5 million business. They'll put a down payment of anything from $500,000 to let's say $2.5 million. So anywhere from 10% to 50% of the purchase price is usually what you'll see. Again, without an SBA loan, they'll go and get loans against the assets in the business. So they'll go to an asset-based lender, they'll go to a bank who's willing to loan against the working capital within the business. So they may loan on the inventory, they may loan on accounts receivable, they may loan on the equipment, and they will do a loan as some kind of term loan or some kind of line of credit that will help finance part of the business. And that varies by how much that is, depending on how many assets are in the business. And then what's left over is the seller finances the rest. And in many, many deals, it's incredibly common for a lot of business acquisitions to use some form of seller financing. So typically you'll see a lot of seller financing be anywhere from a minimum of 10% to typically around 50%. So you'll see that kind of range. So that's typically how you finance it. A little bit of equity, a little bit of conventional debt, and then some seller financing of some sort. If this video was helpful, click that like button and subscribe. Thank you for watching.